Good morning, everyone, and welcome to the Saturday edition of the Dividend Power Hour. It's great to be with you. Thanks for joining me on this Saturday. I get a lot of requests from folks that are over in European countries that say, hey, can you do it on a Saturday and mix it up? So I do like to mix it up. I was on vacation the last couple of days with my son. We were at this indoor water park, and if you're on our email list, I sent out a picture to everyone just showing. I've never been. It's called the Great Wolf Lodge over in the Anaheim area. We had never been. It was a field trip for his school, so it was fun to go and enjoy that. But we're back, and I couldn't miss this week with so much that has been going on with the markets this week. We could not miss an opportunity to talk about what's going on with the Federal Reserve, what is going on with the state of the markets. So that's exactly what we're going to dive into today in this Saturday edition of the Dividend Power Hour. So before we get started, do me a huge favor. Let me know, where are you tuning in from? And how did you buy anything this week? There probably wasn't a ton of buying that was going on, but there probably was some. I nibbled in some areas, but still taking that cautious approach with things. So let me know, where are you tuning in from right now, and what did you buy or sell this week in the markets? And I will tee up our slide deck with that being said. So again, this is the Dividend Power Hour, and if you've joined us before, then this is our economic outlook slide that we go through each and every week. So we like to go through this and kind of just give us a snapshot on where is today's session going to take us. So let's tee it up here. And we have, our markets update. So on the year, the Dow Jones is up 2.5%. So it's still squeaking out and holding on to a gain. It's been the worst performing of all of the three major indexes. And then the S&P 500 is up 13%, followed by the NASDAQ, which is up 27.2%. But you could see there in red what we have done since we did our last Dividend Power Hour, so pretty much 5 days ago. The Dow Jones is down 2.7%. We have the S&P 500, which was down 4.1%. And then the NASDAQ, which was down 5.1%. So not a great week at all for the major indexes, at least over the past 5 trading days. In terms of valuation, right now EPS still sticks at $221 for 2023. But with the major averages coming down, that makes valuations look that much better. So right now, the S&P 500 last week was at 20.4 times. It's been at that inflated level for a number of weeks and months now. But now we're, for the first time in a while, under 20. We're at 19.5. So it's starting to look a little better there. And it's maybe just a breather that we needed in the markets. The 10-year average, as we know, is right around 17.5 times. So that 16 to 17.5 times is the normal range over a number of decades there. In terms of interest rates, we have the 10-year, all of them, interest rates climbing higher, which has put more and more pressure on stocks. We have the 10-year at 4.44, the 2-year at 5.09. You could see where those were last week. The 10-year was at 4.29, and last week the 2-year was just touching 5. So both of those, the 2 and 10-year, which have kind of, the 10-year has leads a lot of where the market's going, but it also is attached to the 30-year mortgage rates. So where housing and mortgage rates are going, they kind of track the 10-year mortgage. So let me move over to the comment section, see where's everyone tuning in from today on this Saturday edition of the Dividend Power Hour. So Jim is in the house. Great to see you, Jim. Jim is a returning viewer there. Matthew, good to see you. Good day. Good morning. If you went to Great Wolf Lodge, that place is a well-run business. Yes, that was my first time. I've lived in Southern California my entire life. Not sure how long it's been there. It was really in the middle of nowhere. But, I look around, it's like, boom, there's this giant building and there's like apartment complexes, housing kind of around it. So it was definitely a unique location there. But it was fun. My kids had a blast. So it was good to kind of check out for a day, especially with where the markets were, kind of take a break and not make any crazy trades. Checking in from Minneapolis, Drew is there. Columbia is in the house. Mark Friend. Awesome. Bought some ARE. REITs got hammered this week. Is it Ian? Ian's thinking about buying some Apple or AMC. Well, two very different companies there. I still think there's a lot of, we've talked about it. If you have joined us on the Dividend Power Hour over the past few weeks or even months, I've kind of been setting it up and teeing it up where I think the markets are going, giving a lot of caution about where, these Fed rates that are going to be higher for longer, interest rates higher for longer. We've talked about that a number of weeks, and here we go. The Fed comes out, and what do they say? They keep interest rates the same. We say we're going to have one more rate hike likely, and we're going to keep rates higher for longer. Everything that we've kind of discussed on this channel now for a number of weeks and months, I think we hit it right, the nail right on the head there. So if you've watched this show, then it should not come as any surprise there of where we're at in the market. I'm digging the couch cushions to buy as much O as I can. Barcelona in the house. Awesome. Nacho, Barcelona, Spain. Bought some Pfizer and WP Carry. That'll be on our today's slide deck. They were in the news. For good reasons and bad reasons. Stock was bad reason. I think it was good news, and we'll talk about that here in a second. Watching from the Cornhusker, I know Jim is in Nebraska there. Bought some RITM, some deer on the downturn. Vici RTX, awesome. What else? I'm gonna bought some VOO, which you can never go wrong with VOO and O. Higino. I probably butchered that name there, so I apologize. But you can never go wrong with buying S&P 500. That is a foundational position. Whether the stocks go up, stocks go down, I look to just add a little bit to VOO, SPY, IVV. All three are different brokerages, but all three tracking the S&P 500 the same exact way. What else? What is a good stock to buy right now? Hopefully, we're going to talk about some of those here. London's in the house. Mukesh is from London, would like to know on REITs. Is it a good time to get in considering interest rates are high but paused? Other question is to know your thoughts on semiconductors, AI company NVIDIA. So NVIDIA has just been a rock star. That has been the leader. If you're going to have a company that's going to be the face of a particular year in 2023, it's NVIDIA, followed by Meta. Meta's had a great year as well, but NVIDIA has just been the tail of the tape in terms of just firing on all cylinders. The stock continues to go up. Valuations are sky high, and the stock continues to climb. The earnings are backing up these high valuations. The growth is there. The demand is there. They're just doing everything right. And you always wonder as an investor, if you own the stock, it's like, oh, well, do I take my earnings right here? Do I take my profits? Well, the stock has proven to be a losing strategy. Although you're taking profits, that's a good thing. But the stock continues to climb higher and higher. NVIDIA is one that's hard not to own, I should say. In terms of REITs, yeah, REITs are struggling right now. They're one of the worst performing asset classes. If you subscribe to my newsletter, you're going to see that I'm actually continuing to bring down my exposure to REITs right now, just due to the fact that we are going to continue to be in this higher for longer, which will be added pressure to the real estate sector. Now, high quality REITs, I'm not changing anything there. It was really just kind of trimming the fat at the lower end, some smaller positions that I have, just saying, hey, do I want this money? If I have, say it's $2,000, do I want this $2,000 sitting in REITs knowing it's going to be under pressure, or should I take that out, take it on the chin, whether if I have a loss in that particular investment, and put it somewhere where I think money is going to do a lot better? That $2,000 could be used in a technology company or an industrial type company, stuff like that. So that's the way to kind of think about it right now. What else do we got out there? We have London, Singapore. So we have London, Singapore. We had Colombia. So awesome. We're getting that international presence. That's what we love to see there. Bought some Berkshire, RSPS, and 3M. Sean, Vici. Vici's, as you guys know, if you've watched this show, that is my largest REIT holding. No changes there for Vici. Philly is in the house with Micah. Birmingham, Alabama, getting ready to watch some football maybe today. What are your thoughts on WPC and the recent news? Roland, great question. We're going to talk about that today, so stay tuned for that. Bought some Maine, CSW, and Verizon. Andrew, transplant from California. Where are you? Andrew's in Birmingham, Alabama now. Got it. Okay. Originally from California. What part of California were you at, Andrew? Tim's holding some cash. Awesome. SCHD took a hit all year long. What else we got? Andrew bought some REITs with NNN, National Retail Properties. BIZD. Not sure. What is BIZD? Not familiar with that one off the top of my head. BDC Income ETF. Got it. Roland's waiting patiently on your coverage of WPC and when we think REITs. Awesome. So great. Roland, big fan from Israel, is in the house also. So we got some great coverage today. I love it, folks. I love it. So yeah, If this is your first time joining, thank you and welcome to the Dividend Power. My name is Mark Rusin. We like to make this interactive. If you have questions, just start shooting those into the comment section. There's even a lot of folks that have joined us over the last few months that could probably even answer some of those questions if I don't have time or I don't see them. But I try and scan through those, take little breaks here and there just to get over to the comment section. But right now we're going to get back to the slide deck here, and let's keep rolling on today's edition. So we talked about markets, where those are at. We saw the last 5 weeks, all of them in the red by a pretty good margin. We looked at valuation under 20 times now, so starting to look a little better, still elevated at 19.5 times. We looked at interest rates. Interest rates go higher. That puts a lot more pressure on our stocks. So now we're going to look at employment. Last week we got jobless, and this comes every week. Jobless claims decreased by 20,000 folks that were looking for unemployment benefits for the first time, down to about 200,000 folks. Analysts, economists were looking for 225. So that was a big number there. Folks that continue to be on unemployment at 1.66 million. Economists were looking for 1.68 million expected. And we could see a little bit of a spike here coming, because if you followed any of these UAW, these auto strikes, labor strikes that are going on, we could see an uptick. Now, number one, if you're on strike, the companies cannot lay you off. But there's a lot of folks that are out there that aren't on strike, and because of these strikes, the automakers are saying, hey, we're going to have to cut some members of the workforce right now, folks that aren't striking. So we could see an uptick here. We'll have to see how those discussions, it seems like maybe Ford is getting closer to a deal. The others not so much. So that'll be something to take note of. And if we do get an uptick, we'll know exactly why. It'll kind of be a short-term event, because I think, if they work these issues out, that they'll quickly rehire those folks. And then we got a Fed decision. That was the big money maker this week, or money taker, I should say. The Federal Reserve and Chairman Jerome Powell and his crew decided to keep interest rates paused at a paused level. And if you've watched the show, we were looking at, all the different likelihoods of a hike or a pause. It was swung in the pause section there. So that didn't come as a surprise. I think what came as a surprise, or what folks were really focused on, was, are we going to have interest rates higher for longer? When do Fed officials believe that we're going to start cutting interest rates? A lot of folks thought it was going to be a lot sooner than Fed officials came out with, and I'm going to show you the dot plot and explain what that is. So I don't think it came as a surprise if you watch the show. I expected a pause. I expect one more hike, and I expected this longer duration of higher interest rates until the Fed sees inflation coming down. So now moving over to housing. Housing is starting to showing some signs. We have these 7-8+% mortgage rates. Who wants an 8% mortgage rate right now? And the thing is usually when interest rates go up, sometimes you'll see some pressures come down off of prices. But over the past few months, we've seen prices continue to go up. Inventory's low, so prices go up. So not only do you have higher prices, but you have an 8% mortgage. It's just making it really difficult. The housing market has been decently strong. New home builders, so brand new homes, doing quite fine just because of inventory levels. Existing home sales, not that great at all. So we'll take a closer look at that today too. So if you guys have questions, make sure you pop those in the comment section. We'll get to them as quickly and as we can, to the extent that we can answer those. So let's see where we're going to start here. So the stock market, we're just going to talk, briefly here. The S&P 500 closed at its worst level of a week period in over 6 months now. So, obviously we didn't have a great week at all. We had 4 straight days of losses. I'm just glad I was gone for that last day, because, when you have 4 straight days of losses, you're probably going to say, oh, okay, this has got to be the end. Let's buy. And emotions can get into that. And I always say emotional trading is a losing strategy. Investors are dealing with the fact that higher interest rates are here to stay. So what that means is you can look over right now and see a 5-6% fixed income. Why a lot of folks are saying, well, let's move some money over there. Let's buy that risk-free 6%. Why would I put my money in the stock market? Let's take some money out of the stock market. Hence the selling pressures that we've seen. That coincides with September, especially the last 2 weeks of September being historically 2 of the worst trading periods for investors. There's a lot of downside pressure historically, just from seasonality, whether it's tax loss harvesting from some of these larger hedge funds, or whether it's, or hedge funds, they close out on a September 30th basis. They have to file a 13F, which is going to, Warren Buffett shows his portfolio. What has he been buying? What has he been selling? Usually about a month and a half after that. But the period was as of the close of the quarter, which is September 30th. So we only have 7 days left, which gives us about 5 days of trading left here in September. So there's a lot of that's going on as well. Higher bond yields tend to equal higher or lower stock prices. So the Fed decision, as we know, they kept things unchanged throughout, based on where interest rates are right now. But the plan is still to have one more rate hike. So we only have two or so more meetings left with the Fed to keep rates higher. So let's look and see where what's the updated CME group here. So I'm going to switch over and take you guys to that page. We'll go full slide here, and you guys can kind of see the CME Fed Watch. So now we've moved things over to the November meeting. So November 1st is our next meeting, as you can see here. And now we're going to, before it was, low 90%. Most folks thought we're going to, keep, or economists thought that we were going to keep things unchanged. That proved to be right. So now we're moving forward. We got that where our rate's going to be. Right now we're in that range of 525 and 550. So this group here believes that rates are going to stay yet again unchanged for the November period. So we're at about, we'll call it 75%, and 25%, 26% believe we are going to get a 25 basis point hike, and that is going to come here at this next meeting. If we move over to December, though, we can see now it's only 55% believe we'll still be at the same target rate that we were last meeting, that we were this meeting. But you can see it starting to creep up. That 38% believe we're going to get at least 25 basis points between now and 2 meetings from now. And 7% actually believe we're going to get 2 more rate hikes. So that's definitely the minority there. So, still sticking to it. So let's look out at probabilities to see where we're at. So the blue shading is kind of going to be where we're at. So you saw that 74% there for the November meeting. The December meeting, we saw it creeped up to a little bit to 55%. We're still going to be at the same. So a lot of officials believe between the December is probably going to be it. If not, it'll be January is where we're going to get our next rate hike. So when do rate cuts come? Before it was in this May period. Well, that's not the case anymore. Now it's likely that we're not going to get rate cuts until July of 2024. And that's just 34% believe that we're going to be around there. So it could not be until the back half of 2024 at the earliest. So definitely something interesting to take a look at there for investors. So 1 rate hike. But right now, the current rate is the highest that we've seen in 22 years, which is definitely going to continue. Now, we've been on this rate hike cycle for about 18 months now. And it's definitely, it's not only the fastest that we've seen, rate hikes in a number of years, but now we're at this level where we went from 0 up to 5.25 just in the snap of a finger. 18 months. We were just hiking for, it was like 12 straight meetings, Fed meetings, that we were seeing rate hikes, and that takes time for it to play out through the system. And that's what a lot of investors are worried about. Just because they do a 25 basis point hike today, it usually doesn't start playing through the system until 6 to 12 months after that. And that's what we're starting to see kind of play out here with the Fed's decision to hike rates. So the other thing that they did, not only did the Fed say we're pausing rates, we are going to kind of keep them at this level, probably do one more hike, higher for longer. But they also updated their GDP, and that's the economic growth here for the U.S. How fast is the economy going to be growing? Well, they now project GDP growth for 2023, so this year, of 2.1%. That's actually more than double what Fed officials predicted at their June meeting. That was the last time they updated their GDP forecast, which was at 1%. So we went from 1% to 2.1%. At this meeting now. So they think the economy is going to pick up. This doesn't tell me that there's a sign of a recession now, according to the Fed officials. And then they also updated their 2024 GDP estimates that went to 1.5%. And they were at the June meeting, they were at 1.1%. So Fed officials believe that, the economy is going to be fine. Now, if you look back historically, the Fed isn't, great at predicting this stuff. Really, no, I mean, it's a shot in the dark, but they have a lot more information than you and I have. So on the Fed's dot plot, so what they do is they create this dot plot when they go through these meetings, and everyone kind of puts, where do you think the Fed interest rate levels are going to be after each period that we're at, and they kind of put their dot, and you kind of see where a lot of agreeance is and where there's some disconnect. So we're going to take a closer look at the dot plot here that was just issued from their latest meeting. But on there, you can see that 12 Fed officials priced in 1 additional hike, and 7 officials actually kept things at the same level throughout the remainder of the year. So here you can see this is the dot plot. And what I'm going to do is let's just go here And that's probably a little bit easier to see potentially. So here's the Fed's latest dot plot. So this is 2023. You can see this period down here through the end of 2023. Here's your 12 officials that believe we're going to get one more rate hike. And here's your 7 officials that believe that we're going to keep rates at the same exact level. From there, though, once we move into 2024, 2025, obviously that's long ways down the road. But you can kind of see how we're trending to a lower area. But how you can kind of see what's the speed at which we're, some dots have come up because initially a lot of folks thought we were going to be cutting rates at a much faster pace. That's not the case anymore. So that's that higher for longer that I've kind of continued to talk about here. So you can kind of see 4 believe we're going to be at that 5.25 level, which is where we're at right now. But then by 2024, you can see a lot more folks think we're going to be below that. So that's when rate cuts are expected from Fed officials there. And then you can see it kind of continues on into 2025 as well. So that's how you read this Fed dot plot. Where do specific officials believe the interest rate, the Fed funds rate, is going to be that particular year by the end of that year? So let's cruise back over here and keep going. So question for you guys. Knowing that we've gone through 18 months since March of 2022, the Federal Reserve has essentially been increasing interest rates at almost every single meeting. We took a pause here. But what grade, if you had to grade the job, you're a teacher now, and you had to grade the job of Chairman Jerome Powell and his team at the Federal Reserve, how would you say they have done so far? For me, if I'm answering this, I'm going to say they were late to the game. They kind of screwed this up entirely by continuing to say this is transitory, inflation's transitory. They went on for this for 3 to 6 months plus talking about inflation being transitory. Well, at that point, with the information that you have, it obviously was not transitory because it's still here today. 2 years later, practically, we still have inflation issues. So late to the game, then they started hiking interest rates in March of 2022. After inflation has already started running rampant. I mean, we got inflation up to over 9%. So definitely late to the game there. I'm probably, they've done a good job. A lot of folks wanted them to say, let's start cutting rates early. I think that would have been a miserable idea because that would have just rehyped inflation. We could have jumped easily back up to 9%. So with that being said, I'm going to give them a C right now. I'm going to say that as long as they stick to their gun, they could easily have been a D, but they've been sticking to their guns and going there and saying, hey, we're just going to keep going by the data here, whether they're looking at the right data or not. I'm going to give them a C, but what would you guys give? You're a teacher. Let's give the Federal Reserve and Jerome Powell a grade on the job that they've done here so far. And with that being said, I'm going to jump over to the comment section and see if I've missed anything there, because I know I've been talking a lot here. So we got Thousand Oaks is where Andrew moved from. Talk about your opinion on the WP Carey spinoff. We will definitely do that. Vancouver, Canada's in the house. Awesome. Jim, Uncle Warren seems to like Japan. He does. The solo travel's been throwing some money into T-bills, and that's exactly what's happening in the overall market. That's what we're talking about here is interest rates. You're getting this risk-free 5-6% plus that you can put money in right now. Why risk it if in a stock market that's saying, hey, we could go into a recession. We have these higher interest rates, which causes you to revalue a lot of your forward projections for specific companies, all valued based on cash flows. Well, it's going to cost a lot more to get those cash flows now with higher interest rates. Fabio, good morning to you. Thanks for joining. What else we got here? Germany's in the house, another country. Awesome. Thank you for your content. You are very welcome. Thank you for joining us. We got another new country in the house today. This is awesome. Is KO Coca-Cola still a good buy at 57.60? So Coca-Cola's had some a rough patch here of late. And I own Coca-Cola. I haven't sold any Coca-Cola. I've actually started to look at it. They got a short report. I forget, it was from the Bear Cave, I want to say. It's kind of they don't usually typically write on stocks like that have been there and been proven themselves. We're talking about one of their arguments was around the fact that the U.S. is starting to get healthier. I don't know if they haven't walked outside in a number of years or something, but there's talks of folks getting healthy. But between getting healthy and actually doing it, we're still a massively obese country. That is not improving at all. So I thought that was a pretty weak example there on why Coca-Cola is struggling. Not the case at all for me. Fabio gives them a B. B320i gives them a C. Oh, we got our first F right there. F plus from Birds and the Bees, a D minus. So they could turn in their homework and maybe get it up to a D minus there. Tim thinks they're chasing all the government's inflationary spending. Sean gives them a C. Iris gives them a B. Would not want to do that job. It is a tough one. I do give them credit for what they do. I would give them a C mainly because they're still not addressing the gigantic national debt that just continues to keep rising there. Treasury bills 6%. Well, a need gives them a D. I'm with you, Kath. Awesome. C. Doug, good to see you. Your content is better than a worthless college degree. Thank you, Conrad. I appreciate that. F minus from Matthew. Oh, way too much money over the past. Okay. So I don't think we got one B, I think. We got one B. We got two Bs. Fabio gave him a B also. So the majority, I would say, is right around a C minus. It seems like the grade that we had there. So let's keep rolling here and see what we got. So now we're going to talk about inflation and jobs. So we're still dealing with this higher inflation stuff, and it's really had little impact on the tight labor market. That part right there has been impressive, that the Federal Reserve, and that's where I want to give credit to Jerome Powell, is the fact that, we have, he's continued to increase interest rates since March of 2022, and we've had very little impact. He's been able to keep the job market intact. Companies aren't having these mass layoffs. In the beginning, we kind of saw it from the technology sector, but that was a lot more due to the fact that they were overhired. During the pandemic times, they were overhired. They just needed so many people that they were just really level setting their employment numbers there. So that wasn't really due to the fact that, we're struggling. We need to lay people off. That's when we started to get worried there. So here you can kind of see how, we talked earlier about how initial claims dropped to about 200,000, the lowest level we've seen since January. But we're starting to kind of see a better balance between them. We're starting to see lower employment growth. Folks aren't getting laid off. So we're seeing lower employment growth, but we've also seen job openings kind of come down. So whether that's a good balance or not, things are starting to definitely balance out. And you kind of see that how initial claims have, they popped up there in the summer months there. But again, if you recall, if you've watched this show before, there was a little bit of finagling that was going on during those months where you quickly saw the next month things dropped right back down because there were some fraudulent claims that went on there. So we're back down to right around where we were at the start of the year in terms of, employment is in a great spot right now, I should say, and something to continue to look for. So that's definitely encouraging for the economy, for the stock market moving forward. So now let's move our attention over to housing. So housing, we continue to deal with these higher interest rates. We're talking about 8% mortgage rates. I'm sitting on what am I at? I think I'm at 2 3/4. I want to say. Why in the world would I want to move? Even if I want to do get out of California and go somewhere more towards Midwest or something. There's a bunch of places I want to go check out. I've heard Idaho, Coeur d'Alene area. I'm a big person with water, so going around lakes and boating and stuff like that. That just sounds fun. I don't know if anyone here is from Coeur d'Alene, but I've heard great things there. Going to check out a lot of the there's Midwest countries. I like barbecue. Some East Coast countries as well. So you never can complain about the East Coast pizza over there. But according to Bear Cave, though, we're all getting healthier. So I guess I should lay off the pizza. So the 30-year average mortgage right now is at 7 3/4, extremely high. Existing home sales fell 0.7% in the month of August. So that has continued. Existing home sales, new home sales are one thing, but existing home sales continue that drop down. And you can see the green line that you see trending there. That's existing home sales dating back to the pandemic times. So it's just continuing to decline there. Inventory fell 14% from a year ago. So already did we have tight labor, or not tight labor conditions? We do have tight labor conditions, but we had tight inventory in terms of housing. That just got even worse as that went down 14% from a year earlier to 1.1 million, the lowest on record since August. And then the median house price grew. Again, higher prices, higher interest rates, lower inventory. It's not a great spot to be in right now for the housing sector, unless you are, again, a home builder building brand new home. But this, the median housing price at 407,100. That's actually the fourth highest on record, and the record was 413, which hit back in June 2022. So not all that long ago, a little over a year ago. So definitely, housing. If you're someone that has to move, it's definitely a tough spot to be in right now. Otherwise, if you have a low interest rate, not sure why folks would move right now. So I want to pause right now and tell you guys a little bit about something exciting that I have upcoming. I briefly mentioned it in our last week's edition of the Dividend Power Hour, but I'm having an options 2-day workshop. I touch on options from here and there, but I haven't really, dove deep into it with a lot of folks. I've had folks take the options accelerator course that I have, where you get to work one-on-one with me. That's an opportunity to do it with as well. That's still there if you want to work one-on-one and understand options. But what I'm going to do is this is going to be more of a group setting. So we're going to do an options 2-day workshop here. It's going to be on October 3rd and 4th. It'll be right around 4 or 5 p.m. is going to be our start time. So we're going to do it. We're going to help you understand what options are. There's a safe way to do options, and there's that YOLO trade that a lot of folks on social media, YouTube can talk about. We're going to turn $5 into $5 million overnight. No, we're not doing any of the YOLO trade. I'm going to show you the exact strategies that I use to accumulate roughly between $3,000 and $6,000 per month just from collecting premiums. What I do, I like to sell covered calls, sell cash secured puts, do different option trades that have a the bottom's not going to drop out. It's going to be in a safer, I want to say, because options in themselves are never just a safe investment, but it's going to be a safer approach to how you can add it to your passive income list. So you're going to utilize it for using options that stocks that you like. If you're wanting to buy a particular stock, the way I get into it isn't usually about just buying today. I sell a cash secured put, collect some premium, and that gives me an opportunity to buy it at a lower price. So if you're interested, the link's going to be down in the description below. You can join our wait list. It's going to be just a limited number of spots that we're going to have for this 2-day workshop. So put it on your calendars. October 3rd and 4th, we'll be going through all those different types of strategies that you use. Covered calls, cash secured puts, utilizing option spreads. And we're going to just talk about so that you can understand first and foremost what are options. We'll have a guest speaker that's going to come on our second day, go through some Q&A where he can talk about his experience and answer any of your questions. So it's going to be a fun, interactive group setting. It won't be the one-on-one like I do with my Investing Accelerator 6-week course. That's one-on-one. This is still going to be intimate though, because we're only going to open it up to a limited number of spots. So if you are interested, check out that link down and just throw your email in there, and we'll get you some information at the closer it gets there. So now we're going to get to stocks that are in the news here. So there's a few stocks. We had some IPOs. We had Instacart go IPO this week. ARM went IPO a few weeks ago, not this week, but the week prior. So we're starting to see some traction with the IPO market there. Did you guys buy any IPO? Either Instacart. There was one other one, and then there's ARM the last 2 weeks. Did you guys buy anything from IPO? I usually don't dabble in any, IPO related stuff, but so stocks in the news, we had Apple. The iPhone 15 was released. That went on sale this week. And there was actually reports that came out of strong order demand. I feel like I say that every single time that the iPhone comes out, but we'll see. The reports that were coming definitely said there's more iPhone 12s right now, and it's usually that 3-year cycle is when a lot of folks like to make that upgrade. So we went from iPhone 12 having a big inventory of folks that actually held iPhone 12 waiting for this iPhone 15. I know Tim Cook was at some of the New York City stores taking pictures with folks. So we'll have to see how that goes. So, Apple is obviously back in the market with a brand new iPhone there with the 15. ARM, as I mentioned, they went IPO. Shares jumped, up 25% out of the gate. But since then, we're just a week and a half in or so. We're right back down to where they went their IPO price. So definitely an interesting one there. Some AI capability. FedEx shares actually went up. They climbed 4%. They've had some momentum here after reporting earnings this week. And then WP Carry. So I know this is what a lot of you have been waiting for. And with WP Carry, I'm going to go over here to my Seeking Alpha so I can kind of show you guys what in the world happened with WP Carry. So here we go. We'll go full screen mode. So WP Carry, quite the year they have had. Stock was down 2% on Friday, down 10% on or 11% the day before. So not a great week for this REIT. And this is actually a REIT that I've liked. We've talked about it on this channel before. So what WP Carry is, for those of you that are new to REITs. Let me scroll over here so you guys can see me while I'm talking. For those of you that are new to REITs, WP Carry is a REIT, or a real estate investment trust, which means they own income producing real estate. So they own industrial buildings, they own warehouse buildings, they have an office component, they have self storage. So pretty well diversified. Although little over 50% is dedicated to warehouse industrial. That's their big game player. Over the years, though, they've had this office component that they've started to sell off. They want to lower their exposure to the office sector, and for good reason. They were actually doing it before the pandemic. I wish they would have done it entirely before the pandemic, but they held on to a little of their office. And now office has just been hammered. With this new work environment that a lot of folks have, where it's, not many people are back to work full time back into a regular office. You have these hybrids where, work 2 days at home, 3 days at the office, or 3 days at home, 2 days in office. There's not that big of a demand anymore for the office sector. So a lot of folks are downsizing or selling out of some of their office buildings completely. And that's exactly what WP Carry is doing here. So they're trying to put together a plan to spin off their entire office sector. So this little article came out here, and you can kind of see WP Carry to leave the office sector through a spinoff and asset sales. So what they're going to do is they're going to split their, if they have 1,000 buildings, they're going to split it, and they're going to take 500 buildings. 500 they're going to sell out on the open market. The other 500 they're going to put into a separate company. They're going to spin that off into its own publicly traded REIT. So it'll be separate from WP Carry, and WP Carry will rid itself from the office sector, and that will take industrials and warehouse and bump that up even higher. So we're talking maybe it's going to be over 65% or more industrial warehouse, which is the area that I really like. I like PLD. I talk a lot about PLD, and their stock prices continue to climb. I like Stag. I don't own Stag right now, but that's one we talk a lot about on the sector because of the monthly dividend. So WP Carry, what do you do with it? Well, in the near term, it sucks because the office sector has sucked, and they're selling this stuff, ton of pressure on it. But if you're a long-term investor, maybe you nibble here, because I think long-term, getting rid of that office component, I don't see a situation where everyone comes back to work full-time. And that's something that's, that's going to continue to weigh on office. I don't really have any specific office REIT in my portfolio. I don't want any of that exposure. I get it through some of these ones that have some exposure. Even Realty Income for years had a little bit of office exposure. WP Carry isn't an office REIT, but it has some office exposure that it's ridding itself from. So I think long-term, that's going to be great. Is the timing great right now? Probably not. So that's what investors didn't like right now with that. So it's kind of unique. I'm trying to weigh because again, I told you guys at the start, I'm trying to bring down a little bit of my REIT exposure right now and focus, less on the number of REITs I have and more on the quality of REITs I have. So keeping Realty Income, keeping Vici Properties, keeping Prologis and stuff like that. So WP Carry, stay tuned. If you subscribe to my weekly newsletter and you're a premium subscriber, you'll have an idea on what I decide to do by the end of this month. So I have only a week to go there. So that's kind of my take on WP Carry. So let's get back here to the slides. Any questions on WP Carry? Just drop those there in the comments section. All right, so let's look at some dividend increases. Let's get back to some good news here. A lot of this has been, Debbie Downer here, but so Starbucks, this week, these are just this week alone. We got some dividend hikes from Starbucks, 7.5%. Keeping right up with inflation, I guess, for those folks that want to compare. Microsoft, 10.3%. That was a good little hike there. I like to see them hovering right around that 10% because you get, a little bit of growth with Microsoft, but you also get that dividend growth as well. So it's kind of the best of both worlds. Still a low yield, and that's fine because, I don't invest in Microsoft for the dividend yield. I invest in Microsoft for the growth. And then we got JP Morgan. They gave us a hike of 5%. So some good dividend hikes that we've seen lately. They are, a little bit on the lower end of things. I thought Microsoft was fine, but I think there's a lot of caution that a lot of these companies are taking, knowing that okay, we have interest rates higher for longer. Is the Fed actually going to push us into a potential recession? Now, if we do go into one, will it be big? I don't suspect that. I think it could be a minor recession, but I'm not in the camp that's saying nope, we're going to have a soft landing. We're in this Goldilocks period. The Fed is doing it exactly right. All is going to be well. I'm not in that camp yet. So Whether I'm behind the curve or not, we'll have to see. So let's take a look here. I'll go to full slide so you guys can see a little bit better. Here's our year-to-date sector performance that I always show you guys each week. Communications and infotech are continuing to lead on a year-to-date basis. And then down there at the bottom, utilities, real estate, and consumer staples bringing up the rear. So we got five sectors that are actually in the red now. Financials have crossed over into the red. And then we have, the remaining 6 are in the green. Largely, though, skewed by consumer discretionary, infotech, and communication services. Let's go over here to the 1 month sector performance. We have energy, and if you have been watching this show, then I've been a big proponent of energy. I've been talking about, buying XLE. And if you subscribe to the premium newsletter, I've been adding to XLE, IEO, which is oil and gas area. And that has just been doing quite well there for us. So energy shouldn't come as any surprise. I don't know if you've had to fill up at the gas station at all recently, but we are well above, last week we were talking about how we were starting to hover around $6 here in California. No, we have blown through that. I just saw $6.50 just a couple days ago. Just completely absurd prices here in California. It's actually cheaper right now to put a bunch of oil on a ship, send it off over to Hawaii. Gas prices are cheaper there in Hawaii than they are here in California. It's just wild. So here's your 1 month sector. Again, energy is leading, followed by utilities. They were a bottom feeder here. So starting to move a little bit, less than 1%, but communication services still doing well. Industry, looking at the bottom though, the bottom feeders for the past month is industrials, real estate still under pressure, materials, and information technology. So definitely something interesting there. So we talked about the options course, but we also have, if you're looking to work with me one-on-one, if you're a new investor, you've been investing for only 0 to 5 years and just looking for that one-on-one attention, look at this 6-week investing accelerator course that I have. There's a link down in the description below. You can set up a quick 15-minute call. We can kind of go through a plan that we're going to put together. In this 6-week investing accelerator course, we're going to put together a customized plan. Our goal is to put together a plan and a strategy for you to utilize for decades, not just right now. It's something that you can utilize for decades in order to build wealth and grow your wealth. And what I want you to create generational wealth. That's just not wealth for you. That's wealth for generations, whether it's kids, grandkids, whatever the case may be, other family members. We're looking to build that generational wealth. You will understand how to manage your portfolio, how to value stocks, how to know when to get in and out of stocks. And we also have that options add-on that you can do for this 6-week course as well. Also, take a look at the free newsletter I send out each and every week. That link will be down in the description as well. And if you want to be a premium subscriber, you can get loads of information, deep dives, earnings recaps, as also you get my monthly portfolio update, talking more about the market, what's going on in my portfolio, what am I buying and selling, what are my top 3 watch list items right now. So with that being said, that is our Saturday edition of the Dividend Power Hour. We're only at about 45 minutes right now, so let's use this time for some Q&A. So if you guys have questions, let's just make sure you throw those down in the comment section below, and I'll be happy to stay for a few minutes if you guys have them. If not, we will get you guys off early to watch some college football, soccer, time with the family, whatever the case may be. So I'm going to scroll up here and see where I left off in terms of questions. We talked about WPC. Amgen. Here's a question. Amgen is up recently until September 20th. Any thoughts? Let's take a look at Amgen. I didn't see any specific news on them. Past 6 months, stocks up 16%. I don't see any news on Amgen. I think it's just, so a lot of healthcare stocks have started to move in the right direction of late, especially if you have any of these weight loss drugs. Eli Lilly is just, if you look at a year chart for Eli Lilly, it's just, incredible. You would think it's NVIDIA almost like. Since March of 2023, the stock has just completely taken off. They've taken a breather since mid-September, so they've been down of late, but still definitely flying high there. So not sure exactly in terms of Amgen there. So here's all of our grades. Finland. We got Finland in the house. Keep up the good work, Mark. Nice to see this live for once. Awesome. Vendog1 from Finland. So we have Finland, we got Germany, we had Colombia, Canada, obviously the US here. We're rolling today. Chile. We got Chile in the house. Ask an economist. No IPOs for the birds and bees. No IPOs for Matt. No IPOs for Drew. Let the dust settle for Tim. Ask an economist, why no REITs for the long term? Better entry point in the future? How about housing REITs? With higher rates, less purchasing of homes. So REITs tend to trade as a group. There's a multitude of different sectors, and that's not all entirely, because if you look at PLD, they've actually done quite well compared to someone like even Realty Income. They're down way. They're kind of going in opposite directions there. So, but the large majority, REITs are going to tend to trade it as interest rates go a lot of the time there. So just know that, if you are getting into REITs and you're looking for value, like, hey, I know these are at low valuations right now. They could go lower, but we're towards the end of this cycle. We're towards the end of the interest rate. We're going to get one more this year, maybe, but likely, are we going to get any more hikes after that? That I would say that's not. I think there's one left, and that is it. Then from there, we just go on this pause, momentum for a little while, and then we start creeping into rate cuts, which is then, once that happens, things can move rather quickly. So that's why I say, well, if you wait for that, is it too late? Does a stock already move 20%? Or, do you nibble here and stop trying to time the market and say, okay, I like this valuation. I'm comfortable with this valuation. Let's buy here. That's what I'm doing with Realty Income. I know that there's going to be continued pressure, but Realty Income over 5.5%, you're getting a price to AFFO around 13 times. Historically, they're at 19 times. We're not talking about historic like over the past 3 to 5 years. Historically, over the past decade plus, Realty Income, regardless of the economic backdrop that's going through recessions and whatnot, they trade at 19 times. That's their average. Right now, they're at 13 times and about dip below 13 times as well. So knowing that, I'm going to say I'm happy to keep adding here. That's kind of my take with REITs. One of my coworkers ordered 2 of those new iPhones, spent nearly $3,000. Wow. Why'd they need 2? What are your thoughts on SCHH? Let's take a look at SCHH question from Christopher. So when it comes to REIT ETFs, this one, let's see what the top holdings are, and I'll bring it up so you guys can see what I'm looking at here. So SCHH is Schwab's version of a REIT ETF. So they have their REIT ETF, and you can kind of see, let's see what the weightings are, if this will work. There we go. So Prologis is the top holding at 9.4%. I love Prologis. American Tower has struggled mightily. Equinix, that's a data center REIT. You have Welltower, healthcare, public storage, obviously self-storage. Crown Castle is another, not data center, but cell tower REIT. Here's another data center REIT. Realty Income, I think that one's a little bit low. So the thing is, when it comes to REIT ETFs, and I've talked about this on the show before, is the fact that there's such a broad number of different REITs and REIT sectors. You have timber REITs, you have apartment REITs, self-storage REITs, office REITs, healthcare REITs. It's just, there's so many different industries within just one REIT industry. So with that being said, I dig into REITs all the time on a weekly basis. I write up about them on Seeking Alpha and stuff like that. And the fact is I would rather own, 10 or so REITs of the highest quality REITs. And if this owns 124 different positions. I'm interested in the top 10 right here, likely not the rest of the 114. Doesn't say there's not any good REITs in there. It's just the fact that I just want the highest quality REITs in these different sectors. You're getting some broad diversification here, but I don't need exposure to 124 different REITs because there's just a lot of bad ones out there as well, and much smaller ones. They're not going to move, and it's just going to weigh you down, where I'd rather have these ones that I can kind of rely on moving forward. Good question, though. What do we got here from Jay Oliveira? I think retail and REITs are set for a large rebound in 2024. I own DG, Target, WBA, Walgreens, Realty Income, American Tower, and adding heavy at these levels. Healthcare is also looking attractive. Been adding to Pfizer. Pfizer has been down in the dumps. I'm definitely hoping you're right there in 2024. I think, especially as the interest rates start to settle and folks start to understand that, they're not going higher here, I think that's going to benefit REITs. When we start getting into cuts, that's really going to benefit REITs. So how much lower? We've gone a long ways down. Like, let's just look at the summary here. You could see that this is down 9%, this REIT ETF over the past year. Look, year to date, it's going to be down 6.7, but it's really taken a tumble, which is largely due to, if it has exposure to WP carry, but REITs in general just got hammered the past week. How much lower can you go? I mean, you're looking at valuations, even with expectations for earnings coming down, AFFO earnings coming down, we're still looking at extremely low valuations. So, I'm as long as you're happy at the valuation rate, I think these are great spots to nibble at. All right, what else we got? Good question there. Office is still not a spot that I'm going to, Conrad, I see your question there, is still not a spot I'm looking to add and probably won't add. Just not a lot of intrigue there. I have some Alexandria that's in the office REIT sector, but it's more healthcare type offices there. Jim with a question, thoughts on Verizon with ex-dividend around the corner. So let's pull up Verizon here. Still have that screen up. That's perfect. So Verizon, the problem with Verizon is there's been, they have high debt levels. They have their lead issues. They have strong competition with the likes of the big three being, but there's more than that, as you know now. You have Verizon, AT&T, T-Mobile's been, they've had all of the momentum of late. And the thing is, I've had Verizon in the past. I've had AT&T in the past. Got rid of AT&T in the low 30s, bought back in around, I want to say 18. Then more of these issues came out. I said, no, I'm done. I'm just done. It's too, I don't see a path to where it's going to jump and you're going to get sizable amount of growth. If you want a yield, that's great. But at the same time, we don't want to be yield hunting here. When you get 8% yield, but you have a stock down 16%, your total return for that particular year is going to be obviously negative. And I just feel like that continues to be the case with these legacy companies like Verizon and AT&T. I put them in the bucket together. Valuations, though, if you're a value investor, just saying, hey, these are incredibly cheap, like I was just talking about with Realty Income, their total return is down on the year. You get 5.5% yield, but the stock's down 20%, total return negative. But I just feel like that's not a continued process. There's a reason behind it for the likes of Realty Income. The reason here is more people are buying more phones, having more plans. What is we have internet with fiber, all they have. AT&T is a separate issue. They were starting to get into all this media jargon and doing stuff that they weren't accustomed to doing. It was outside of their comfort zone. That added more debt. It obviously it was not an accretive investment for them. So for that reason, I don't see the path higher. Instead of just saying valuation alone, it's great for Verizon. I just don't see a growth path forward where this stock turns around and goes up to 42, in the next year or something like that, and goes up, $10. So for that reason, I'm kind of staying on the sidelines when it comes to both Verizon and AT&T. I don't want to lurk just for the dividend alone. Will AbbVie ever break through 155? When it does, by the time I'm done accumulating shares, I hope so. But this is where, if you're a long-term investor and you have a time horizon of 5 years out, take that opportunity to add to high quality positions, because you're going to look back and say, man, I wish I added more. I wish I had more AbbVie. I wish I had more Realty Income. Whatever the case may be. And that goes back to the last question. I don't know if I'm going to sit there 5 years from now and say, oh, I wish I had more Verizon. Just seeing that how much a lot of these faster growing companies are just surpassing them, whether they have a higher or lower dividend yield or dividend yield at all. So I think there's a lot of exciting things going on in the market right now. So, but AbbVie is one of my top positions. Love what they're doing there. It's kind of a waiting. We're in that transition period right now that management has made us fully aware of. They have Rinvoq and Skyrizi. Both of those together are expected to be above and beyond what Humira was at its peak. Humira sales come down, albeit they're not coming down as fast as a lot of folks thought, which is a good thing for AbbVie and its investors. But they have a strong pipeline, and AbbVie's a company that I'm definitely going to stay invested in there. Ben tuning in from Quebec. Awesome. Norway. We added another one. There we go. Hi, I'm from Norway. But I am from Romania. So maybe you're in Norway now, but from Romania, or live in Norway now, and you were born in Romania. So we'll take both. We'll take both there. Cyprus. One for you, one for the spouse. Oh, that's on the iPhone question. Awesome. We got some Corona in the house. That's not too far away right there. Awesome. Thanks for tuning in. Any thoughts on MPW? I already have some and I don't want to sell on 50%. MPW is just one of those where it's sometimes better just to cut the fat. I know it's hard to hold on to those losers and say, oh, well, let's just wait for it to come around. But as you've seen just over the past year, you may have thought it was coming around here. Probably would have been a better time to sell. And then we went back down. And then it went back up. Probably would have been a better time to sell right there. And then we went back down. And then we went back up. And it was probably a better time to sell right there. And now we've crashed down to $5. We are pretty much a penny stock now with Medical Properties Trust management there. I just do not trust the dividend's not going to be something that's going to continue to be there, I believe. And that is just a lot going on. I am just so thankful that I got out of that stock a couple years ago, thankfully. Do you think REITs are going down? Do you think the REIT is going to cause housing prices to go down and having the trickle down effect? No, the thing with housing is due to the fact that the inventory is so low. There's such a high demand there for, I think mortgage rates can weigh on it a lot more. And if we see mortgage rates stick at these high 8% levels, then you're going to have, less bidding wars. But the problem is no one wants to sell right now. So what's the inventory? What's the way to bring inventory levels up right now? Because if we have higher inventory, that can bring pressure down on the median sales price. But no one wants to sell right now. And the only way you have a way to add inventory is through new home builds. So they cannot build them fast enough. Mason, I got caught by WPC disaster. No problem there. I own it as well. I don't think anyone could have foreseen that. There's just some things in investing that you're not going to foresee, and it's just part of it. It's not a red flag on the business at all. Again, like I mentioned, if you were here for that segment a few minutes ago, I think long term it's going to be great being out of the office sector. So I'm happy about that. Not happy about the near term, stuff. I'm approving Humira consistently and a lot more Skyrizi lately. That's a good right there. Must be a physician. Devo, Jeppy, XYLD or question mark. So if you're looking for yield near term, I don't have a problem with any of these. One of the unique ones that I met with the fund managers on that kind of came out recently was the Defiance NASDAQ 100 options income. So they're doing kind of these spinoffs that are going to track QQQ or a knockoff of Jeppy. They have a JEPY. So what they're doing is it's just strictly options. They're going to sell one option, but they're doing 0 DTE options, which means that the options have expiration dates. And this particular fund, what they do is they buy 0 DTE options, which expire in less than 1 day. So at the end of the close on Friday, they went out and sold, or I didn't say buy, I should say they sold a cash secured put or an option, which is going to expire on Monday. So if the particular stock with the index that they track, which is the QQQ, if it stays the same or goes higher, they collect their income and they do it again the next day. That's the same exact strategy that I do, except I don't do 0 DTEs. We look at 2 weeks, 1 month out, 30 days out, whatever it may be. And do our options that way. It's so much safer. You can have, if the index swings, one way or the other quite hard, or it doesn't even have to swing quite hard, you can, lose money that way. So, but they're just doing one option. So, the yield on this one's going to be huge. It just started trading last week, JEPY, which you can see over here on the right side. Same thing. It's kind of tracking the same stuff that Jeppy does, but they're going to have huge yields, but it can have some volatility there in terms of, the yield can be up high, the yield can be down low. It really going to depend on how they did that particular month, but both of these pay on a monthly basis. So something to watch, not something I'm jumping into, but something to watch. I talked to the investment managers, got an idea, did a write-up. I helped do, Brad Thomas right here do this write-up that you see down on the screen there. So, I'm interested to see how they do and what the yields end up being here. So, Birds and Bees, I still have to read your book. I have the link in the email, maybe for a few weeks. Was on the road working. No worries. And if you guys haven't, make sure you subscribe to our newsletter. We're sending out, weekly newsletters talking about the market. And it's also a way for you to be able to connect with me. That's coming straight from myself. So if you guys haven't done, this is going to wrap up our Dividend Saturday edition of the Dividend Power Hour. Thank you guys for joining. Definitely check out the link for the options, October 3rd and October 4th. It's our 2-day option workshop that we're going to do. It's going to be a group setting. The price will be $197. And this is going to be the lowest that this 2-day workshop. This is our first one. So that's the lowest this price will be. And as we go on there, we'll continue to do these, but our price is going to go up. So it's just going to be a number, a select few number of folks that's going to be in this first group. We're going to have some Q&A session also. So you'll have an opportunity to ask questions. It's not just going to be heavy information related. So definitely check that out down below. And if you're interested in working more with me full time, then let's definitely, get you on the schedule to talk about the 6-week. There we go. What we're going to do is a 6-week investing accelerator course. I have 3 more spots that are opening up. So at the end of this month, beginning of next month, I should say, is when we're going to start for 3 more spots. If you want to work one-on-one, you could do those once a week. You could do those every 2 to 3 days. It's really up to you. It's completely customizable, but we're going to put together a strategy and help you understand how to invest the right way and put a plan together for decades. So definitely, if that's something of interest, you can check out the link down there, schedule a 15-minute call. We'll go through everything and get you signed up so you can hold one of those spots. So I hope you guys have a great Saturday. Thanks for tuning in today from all over the world today. It's pretty unique being able to do these Saturday ones. We'll try and do these, every once in a while, just so our all the folks over in Europe can join us as well, because it's always fun getting new perspectives on investors that are investing here in the U.S. stock market. So with that being said, I thank you guys so much for the support. Hopefully we'll see you at our workshop or the 6-week course. And with that being said, have a great Saturday and a great weekend. Take care.